Even a week full of political news cannot completely distract traders from a macroeconomic data. The more uncertainty in the political arena, the more important macroeconomic indicators become. They are once again highlighting a green path for the euro's dollar. Fed Reserve officials reviewing the latest data are anonymously advising against Russian to cut interest rates. They emphasize that a strong economy is the key to stability. Therefore, economic statistics remain the main driver of market trends. We are watching traders' calendar for February 20. Despite being released weekly, US crude oil inventory data is closely monitored by most commodity traders. Now, these reports are published one day later on Thursday. The first release from the American Petroleum Institute recorded inventory growth for the first consecutive week. The previous data exceeded the forecast of 2.8 million barrels, surging to 9.43 million barrels, the largest weekly increase since March. Naturally, this caused oil prices to drop. Later, the official report from the U.S. Energy Information Administration contradicted the earlier data, showing inventories nearly halved. For the weekend in February 7, reserves in the U.S. storage dropped from 8.6 to 4 million barrels. Experts now forecast a full decline to just over 1 million barrels. If the reduction is confirmed, oil prices could rebound by the end of the Thursday's trading. The first half of the day is likely to be challenging for the oil prices as other macroeconomic indicators could whine against them. For example, Australia's labour market report may show a sharp decline. Employment growth for January is expected at around 20,000, a notable drop from December's increase of 56,000. This is a negative factor for the Australian dollar, which as a commodity currency could pressure WTI and the Brent oil prices. One more factor affecting the oil market will be the People's Bank of China's rate decision on a 1-year and a 5-year loan prime rates. The 1-year rate mainly affects new and outstanding loans, while the 5-year rate is closely tied to mortgages. Rate hikes signal tighter credit conditions and lower inflation benefiting the yuan. Rate cuts, on the other hand, are seen as an economic stimulus which could boost demand for the commodities including oil. However, both rates are expected to remain unchanged at the 3.1% and the 3.6%. Such a stable decision from the Public Bank of China may cause only slight volatility for the yuan and oil. The euro is expected to strengthen if Germany's producer prices for January confirm an acceleration from 0.8 to 1.3%. Such a rise would support the uptrend that began in December, signaling that Germany's economy may be recovering after more than a year of deflation. The increase in a producer cost could partly be attributed to stockpiling ahead of a possible US tariffs on the EU under Donald Trump's policies. Nevertheless, the euro is likely to respond with gains against the US dollar. The pound sterling may support the euro's upward trend. The industrial orders balance in the United Kingdom is expected to improve from a minus 34 points to minus 30 points. This indicator is a forward-looking, reflecting February's outlook. In December, the index dropped to a 4-year low of a minus 14 points. Compared to that level, any February increase would appear optimistic for both the pound sterling and the European currencies overall. The Canadian dollar could also see gains this day. Rising producer prices typically signal inflation, which may prompt the Bank of Canada to raise rates, supporting the currency similarly to the US dollar's response to rate hikes. In December, producer price surged from a 2.2% to 4.1%, marking the largest increase since January 2023. However, concerns loom. As Donald Trump threatens new tariffs, Canadian manufacturers may have inflated their prices by stockpiling. If US tariffs materialize, inflation could flip to deflation due to the foreign production and others. Meanwhile, the US labor market could face disruptions. Recent policy actions under Donald Trump's administration have hit multiple job sectors. His measures include massive deportations of illegal immigrants and major cuts of agencies such as USAID. The administration plans to reduce the federal workforce by up to 10%, aiming to cut costs. Notably, the National Nuclear Security Administration recently laid off 300 or 400 employees, a more already deemed a mistake. Such actions paint a bleak picture of the US labor market, with the initial jobless claims expected to rise by about 3,000. The greenback may weaken. Adding to concerns, the Philadelphia Fed Manufacturing Index could plunge from a 44 to 16 points. As a leading indicator, such a drop would be worrying, especially since the January report showed the highest monthly rise since June 2020. A sharp reversal would be a bearish signal for the dollar bulls. Against this backdrop, the Eurozone's Consumer Confidence Index appears stable but is expected to improve to minus 14 points in February. Although the increase is modest, it could support a moderate rise in the euro against the US dollar, assuming no unexpected political events interfere. These speeches from the US and the Eurozone central bank officials may spark volatility as their comments often hint at future monetary policy directions. Please note that the time of our publications is set in a GMT plus 3. The next video review of a trader's calendar will be released on a Thursday, February 20. We wish you profitable trading and see you soon.